Hi, welcome back. And this video is was triggered by a tweet that was put out last week by Joe Wiesenthal from Bloomberg. Always worth a follow on social media. Joe on Twitter, he's at the Stalwart, and he's also one of the co-producers of the podcast Odd Lots podcast, which is a really good financial podcast again offered through Bloomberg. Now, Joe put out a tweet last week showing some investment bank research, I think it was from Deutsche Bank, showing that the markets, the Fed fund markets, typically overestimates the pace of Fed hikes. And the point that Joe was making was that, about the idea that the market is right, and as a viewer, you'll hear it many, many times, from people, the market's always right. And Joe was saying, well, the market, if you look historically, is consistently wrong about the pace of Fed hikes. And I retweeted that and want to talk a little bit more about why I retweeted it and what the point is and why this idea of the market being right has been so misused by traders for such a long time now. So there was the idea that the market is right, and what people get mixed up with is the notion that the market is ahead. So if we look at it, that the research that Joe Wiesenthal was referring to showed that historically the Fed funds market is a terrible predictor of Fed hikes. It overestimates, and many people believe this idea that the market is ahead. If you use technical analysis, then that's one of the core assumptions of technical analysis. The reason why you will follow trends or look for trends is the belief that the market is ahead. Now, I simply don't agree with that, and I don't think many of the practitioners at the higher level professional traders believe in that. That's why we don't use technical analysis. If, for example, you look at 2-year bonds in the US and you go to early March, 2-year bond yields in early March were about 5%. They're pricing in higher for longer, higher inflation, higher interest rates, that kind of environment. Just about a week later, they're yielding 4% and slightly below. That's a massive change. It was one of the, a huge move in the bond market, one of the biggest ever. 2-year bond yields went from 5% to 4%. Complete change of view. Now, was the market right when it was pricing in 5%? Is it right when it's pricing in 4%? The idea that the market is right, or is ahead, was it ahead when it priced in 5%? Is it ahead now it's pricing in 4%? 1 week apart, the bond market in the US was showing completely different thing. And I've already used the expression that actually sums up what's really happening here. The market is not ahead. It's pricing in. And if you believe that, it's a very different concept. So, to believe at 5% that the market is ahead, this is what's going to happen, the Fed is going to do this. A week later, the market is showing the Fed doing something completely different. So it couldn't have been ahead a week before. It couldn't have been right. Or is it not right at 4%? You can see the dilemma here. That's why the idea, and if your trading incorporates the idea that the market is right, the market knows what's going on, you're making a mistake. What's really happening is the market is pricing in certain outcomes. And as new information hits, the market will change what it's pricing in. It will reflect new information. And it could be wrong. As the market priced in 5% bond yields, new information came to light. As inflation perhaps is dropped lower than the market is expected, it's going to change what it prices in. The people a week ago, to assume that they are right, that they know what's going to happen, which is the underlying principle assumption behind technical analysis, it's clearly wrong. And your trading will improve significantly, particularly if you're a position trader, if you start to talk about it from the perspective of pricing in. What's it pricing in? What could happen? What could change that? That's how markets are working. So let's come back to this expression. The market is right. You're going to hear that a lot. Now, when I first started hearing that expression, and when I've used that in the past, it's got nothing to do with the market actually what it's pricing in or what it believes, because I know that the market can get things wrong or can change its mind within a week. The way I've used that in the past, the way I've explained it to traders when I'm teaching them, is more about when you have a position and you're losing money, for you'll hear people say, I am right and they are wrong, as they continually lose money. I've seen it lots of times, very stubborn traders. That's the environment that I've used that to say you don't have the capability to say now that you are right and they are wrong. Okay, your P&L is showing you what you're doing. You're losing money. You need to cut the trade. At some point, if you want to go back into that trade, you can do it at another point. But that's where the expression "the market is right" is your P&L is telling you, what's happening right now, and whether in the long run you're right, well, you might not make it, because if you suffer losses for too long, you'll get knocked out of the trade, margin called or whatever. So in that perspective, that's where that expression, where I have used it and found it in and first sort of heard about it in trading, in terms of your P&L. If your P&L is constantly losing, you really don't have the ability to say, I am right and the market is wrong and I'm just going to wait here. Because most often, you just don't have that opportunity to carry it that long. In terms of the view that the market is right, it knows what's going to happen, no, that's a very different thing, a very different meaning. And I think over the years, it sort of got confused, and a lot of people just love saying that the market is right, but it's just simply not true. So I've always said that I think one of the main areas that position traders go wrong with in the retail industry, and they're pushed this way by the educators, by technical analysis and so forth, is the view that the market is ahead. It knows what's going to happen. And those of us that have been trading, and you don't have to trade for very long. If you've been trading since March, you would have seen a number of examples where 1 week the market is pricing in one thing and 1 week is pricing in something completely different. If you'd have followed the people the week before, assuming that they were ahead, that they knew what was going to happen, you were wrong. What you need to do is understand the principle of pricing in, understand that these people can be wrong, and understand how that can affect the probabilities and the likelihood of different outcomes going forward. So I hope this, again, will make position traders in particular think about it. But this term, the market is right, is a term that can be dangerous if you use it incorrectly.